Internal controls provide reasonable assurance of operations, reporting, and compliance. Internal controls are designed to provide reasonable assurance that the organization achieves three main objectives: effective and efficient operations, reliable financial reporting, and compliance with laws and regulations. Effective operations mean that resources are used properly and business activities are carried out as planned. Controls such as approvals, budgets, and performance reviews help ensure that the company operates efficiently. Without these controls, resources may be wasted, and management may not know whether the organization is meeting its goals. Internal controls therefore support both performance and accountability. Reliable financial reporting is another key objective of internal control. Accounting records must be accurate, complete, and prepared according to established standards so that users can trust the financial statements. Controls such as authorization of transactions, proper documentation, and regular reconciliation help ensure that financial information is correct. If financial reports are unreliable, investors, creditors, and managers may make poor decisions. Strong internal controls reduce the risk of errors and fraud and increase confidence in the reported results. Compliance with laws and regulations is the third objective of internal control. Businesses must follow tax rules, labor laws, environmental regulations, and accounting standards. Internal controls help ensure that employees follow these requirements by establishing procedures, approvals, and reviews. Failure to comply with laws may result in penalties, fines, or damage to reputation. By monitoring activities and enforcing policies, internal controls help the organization avoid legal problems and maintain good standing with regulators and the public. Internal controls provide reasonable assurance, not absolute assurance, because of practical limitations. Controls depend on human judgment, may be overridden by management, and must consider cost versus benefit. For example, it may not be practical to review every transaction in detail. Instead, organizations design controls that reduce risk to an acceptable level. Understanding that internal controls provide reasonable assurance helps users recognize that some risk always exists, even in well-managed organizations. This concept is fundamental to accounting, auditing, and business management. Define segregation of duties. Segregation of duties is an internal control principle that requires different people to perform different parts of a transaction. The purpose is to reduce the risk of errors or fraud by ensuring that no single person has complete control over all aspects of a financial activity. For example, the person who authorizes a transaction should not also record it or handle the related assets. By dividing responsibilities, the organization creates a system of checks and balances in which one employee's work is reviewed by another. This makes it more difficult for mistakes or dishonest actions to go unnoticed. A common way to apply segregation of duties is to separate authorization, record-keeping, and custody of assets. Authorization means approving a transaction, record-keeping means entering the transaction in the accounting records, and custody means having physical control of the asset, such as cash or inventory. When these duties are performed by different people, it becomes harder for an employee to both commit and hide an error or fraud. This separation is one of the most important controls in accounting systems and is widely used in organizations of all sizes. Segregation of duties also improves accuracy because work performed by one person is checked by another. For example, one employee may prepare a payment, while another approves it and a third records it in the ledger. This process increases the chance that mistakes will be detected before they affect financial statements. Even in small organizations where full separation is not possible, management should try to create compensating controls, such as increased supervision or independent review, to reduce risk. These additional controls help maintain reliability. The effectiveness of segregation of duties depends on proper supervision and clear assignment of responsibilities. Employees must understand their roles and follow established procedures. Management should regularly review work, perform reconciliations, and investigate unusual transactions. If duties are not properly separated or monitored, internal control risk increases. Because of its importance in preventing fraud and ensuring accurate reporting, segregation of duties is considered a fundamental principle of internal control and is required in most well-designed accounting systems.